What's up guys, Mike here, doing an ASOS video. I got a few messages from some people out there wondering what I thought about ASOS earnings, and I will let you know in this video. I did sell my shares this quarter, so I want to let you know up front. I'll talk about why in the video, but I'm probably just going to talk. I won't do much editing on this video. I won't put many screenshots in and stuff like that, just to save myself time because I'm pretty busy. But I wanted to let you guys know what I thought about ASOS because I know there are some questions. All right, so as you know, these results were pretty bad. Sales down 7%. They're guiding at more than 10% down in sales in the second half and guiding to positive pre-tax profit, which is good. But the reason I sold is because I don't know what's going on. I actually don't know where I am now. These earnings really kind of messed me up. I thought there was more rope to play with here than I think there is now. The debt situation is pretty concerning for me. The fact that the revolver only got extended to November next year, 2024, and it actually steps down in August, which shows me the debt holders are not actually feeling good about this company. This is a huge, for me, this is my worst result in quite a long time. I'm down 58%. I sold down 58%. I sold at 505 US, that's actually a really bad trade too. I'm usually better at sort of entries and exits on the trading side. And I just, as soon as I realized I didn't know where I was on this, I just sold it. And I do think that the stock's probably oversold at £4. And, you know, that was probably an emotional bad exit for me. So I may have bottom ticked it on the sale, which is terrible. But my view on it is when I'm wrong or when I really don't know where I am, I have to get out. And that's sort of what was going on here. Now, I think, like, if we look back at my thesis, basically it was you're just waiting for one good year or one up year in terms of margins, and then the stock is going to revalue quite a lot higher. I do still think that's the case, but my main concern here is the debt. They may actually run out of room before they get to that good year. And I also have an economic concern because, like, high interest rates here they're eventually going to bite, I think. And with a company like ASOS, I think you need an economic expansion before you get to a full-blown severe recession. If you get a full-blown recession, I think it might be game over. So what do you think's coming first? Do you think that we're going to normalize and discretionary spending is going to go back up? Because this is not, this is not necessary purchases for people. Like, if they're going to cut somewhere, they're going to cut on excess clothes purchases. They're going to cut on things like travel and stuff like that first. And I think that that's what's happening right now. I actually believe we're in a mild recession. We have been in a mild recession for maybe a year now, just due to inflation just crushing everybody's purchasing power. But like I said, if it gets worse and these interest rates start nailing homeowners and businesses, stuff could get a lot worse. I'm not saying that's going to happen, but for me, it's a gamble based on which one's going to happen first. And I actually have no idea. So, like, I'll just go into some of the items here from the earnings and my take on them. They are improving their margins, it looks like, and they're expected to cut another 200 million from sales in the second half, that's pretty good. That's a pretty good outcome. The problem is the sales are declining so quickly that it's eating any benefit that they're seeing from those cuts. So that's concerning to me. I think that the upside that they're going for is just it's just getting eaten by the shrinking. Now they're talking about how they're getting rid of their least profitable customers, and so the sales shrinking is not actually bad. I think that might be partially spin, because I think there are losing customers just based on the cost of living problem, especially in the UK right now. You know, the US results look really bad to me. The premier customers went down, like, and even the sales went down. So that's a big growth area, and that's where I thought the upside was. And it doesn't look like they're getting very much traction in the US. Now they're still strong in their core market, which is the, you know, the 20-year-old consumer in the UK. So that's good. I just don't know how big a company what the potential there is. Like, is there really $4 billion worth of sales that can anchor on that consumer? I'm not really sure. So like I said, I just don't know where I am. I can't really see the upside from here. And so actually, what else do I want to talk about here? So the visits were down everywhere. Average basket value, or ABV, I think that's what it stands for, is up in all markets. So that's good. So that means what they're saying is, you know, they have fewer customers, but they're spending more. That's a good trend. But again, the overall sales decline is eating a lot of that benefit. Gross margins were flat, and they said this is good, and they said this is actually up. I didn't check into what they're comparing to, but year over year was flat, and they're saying it's due to headwinds, right? And so I looked into headwinds. That's inflation. Yep, legitimate headwind. I do believe that's going to go away, but I think it might go away because of this recessionary state that the Western world is in. People are just going to spend less, and costs are going to come down to adjust. So there's inflation. They say the return rate is normalizing. Again, I don't know if that, the last I heard on their returns, those were actually causing cost problems because they were abnormal. So you would think that returning to normal return rates would be good for them, but they're saying it's a cost headwind. So if anybody understands that, like, maybe put it in the comments. Maybe, what am I missing here? Like, why is that actually adding to costs when I think it should be you know, going the other way? The free cash flow for the half was negative 263 million. The net debt is now up to 430 million. So this is my concern. This is where my concern starts to come in. Like, those are pretty big numbers, and you have an enterprise value of around 930 million now. They say that in the second half, the free cash flow is going to be positive 150, but they've already missed so far, and they're saying they're guiding right at the bottom edge of their original guidance, and so this possibly could come in worse. And I don't know if that's real net cash flow. I think their actual cash change will not be a positive of 150 million. So the way I see it is you're going to have this positive free cash flow because of seasonal effects, but then you're headed right back into the first half of the fiscal year, that the last 2 years have been 250 and 260 negative free cash flow. So I'm concerned they're not actually you know, posting positive numbers at this point. Plus you have your revolving credit line expiring in November next year. It doesn't look like the debt holder's happy. Sorry, the lender is happy, and so yeah, it looks a bit sketchier there. So if I'm thinking from an upside view, what's the upside here, right? I do think if we do get these you know, positive earnings prints, like they said they're going to print 40 to 60 million in positive EBIT in the second half, and annualized that's 80 to 120 million. So that's actually not bad if they get there, right? And I think the stock could react pretty positively if they post in that range, just based on sort of some enthusiasm of, oh, there's some light at the end of the tunnel here. But now if I dig a little bit deeper, that's EBIT, and they say they're gonna have 30 million in interest costs because for the first half. So you actually only have of 10 to 30 million in pre-tax profit. which is not that much. That's about a 1% margin, sort of midpoint, annualized. So the upside, I think, it could run up into the next set of earnings. I think that maybe I should have just held and looked for a better exit. But if the next earnings comes out and they look pretty positive, then I think the stock might get a fairly decent revalue. If they can get to cash flow positive and they guide for first half next year, like 150 million or less in free cash flow burn, then you might see, oh, look, we're actually coming out of the tunnel. But for me, that's a gamble. I have no visibility into that. I have no visibility into 2024. And I think they absolutely need to have a win in 2024 to avoid something pretty nasty happening, right? You could get taken over by debt holders. They could have a huge equity raise, which would dilute everyone. Like they'd have to dilute pretty severely for the cash that they need. The other upside that I talked about in my videos was, if they just had an outright sale of the company. And looking in 2021, early 2022, the prices looked like, they're kind of averaging about 1-time sales in the industry. And I was looking through some of the more recent sales. There's not that many now because I think the interest rates have caused a problem. But Board Riders was recently bought by Authentic Brands for 0.4 times sales. Okay, and that's way down from the 1-time sales or the 0.8 from last year. And I imagine that's due to interest rates and the lack of demand right now for for fashion companies. So if ASOS was to sell at 0.4 times revenue, that would be a $1.4 billion sales price. Take off the 400 million in net debt. It might be up to more like 500 next year. I don't know, 600. But let's say it's 400 million. That leaves $1 billion for the stockholders, which is about 10 pounds. So that's a double if that happens. But again, I haven't heard any rumors about this. I don't have any insight into that is even a possibility. But it is an out. If I'm them, I would say, okay, well, that's one potential way out of this, right? We could just sell to a bigger brand, and the bigger brand may, something like Zara or H&M or something like that, takes them over. So I don't really know what else I'm going to talk about here. It's pretty disappointing. I have to be honest. Like I totally messed this up, and I took a big hit on it, and it still stings. But that's investing. Nobody has 100% hit rate, and the goal is to minimize the bad decisions. And this was clearly a bad decision for me. Now, that said, I don't mind a gamble. This was always a gamble. It was a 5x upside versus a big downside potential, right? I'm totally fine with that scenario, and I probably would do this trade again. The problem that I believe I made here, one of the problems was sizing the position. I ended up with a 10% position on this, which means I lost 5.8% of my portfolio on it. That's a huge hit on one position. Now, I'm pretty concentrated generally, but I think a better strategy for stocks like this that are a bit of a gamble, like I'm looking at stuff like Sleep Number, I'm looking at AppLovin, both interesting companies, both a bit of a shot in the dark gamble with pretty big upside and also a big downside available. I want to size those more like 2 to 3% and then have a basket of them, and just do it that way, right? Rather than all the eggs in one basket. So that was one of the mistakes I made that I'll correct going forward. But yeah, I hope you got something from this video. And if you have any comments on this company or anything you think I got wrong, please let me know. I'm very happy to be wrong, and I would be interested in getting into this if I had more clarity on what was coming. So if you think I'm missing something, please let me know. And thanks for watching. We will catch you in the next video.